Sometimes it feels like you really need a secret decoder ring just to keep up with finance, doesn't it? Especially with all the regulation.
It's a complex world out there.
But underneath all that complexity, there's this drive, this need to actually understand what's really happening.
Yeah, to get some clarity.
Exactly. And that's precisely what we're aiming for today. We're going to take a deep dive into the Securities Finance Transaction Regulation, SFTR, over in the EU.
Absolutely. And SFTR, it's not just some, dry piece of legislation collecting dust somewhere. It actually has a pretty big impact on, well, a significant part of the financial world.
Right.
So understanding it is, I think, pretty crucial. Not just for market stability, but as we'll get into, it even plays a role, maybe unexpectedly, in tackling financial crime.
Okay.
So our mission really for this dive is to unpack what SFTR is all about, where did it come from, who does it actually apply to, and what's this link to fighting financial crime. We'll be looking mainly at things like repurchase agreements, repos, you often hear them called.
Right. Repo.
And securities lending, margin lending, that kind of transaction.
Okay, great. Let's start unpacking that then. So, what exactly is SFTR, and why did the EU feel the need to put this whole framework into place?
Well, fundamentally, SFTR is an EU regulation. Its main purpose is really about increasing transparency, specifically in the markets for securities financing.
Okay, transparency.
Yeah, think of it as trying to shine a light on what people often call the shadow banking sector. The core idea is to give regulators a much, much clearer view of the risks involved when securities and collateral are exchanged temporarily,
Ah, okay.
which, as we just said, is the basic mechanism behind repos, securities lending, and margin lending.
So it's really about getting a detailed picture of like who's borrowing what asset, who are they borrowing it from, and what's being put up as security for that temporary exchange.
Precisely. Yeah. By forcing the detailed reporting of every single one of these transactions, and we're talking millions of reports daily, it's a huge volume of data.
Millions. Wow.
Yeah, unprecedented amounts. It helps regulators keep tabs on the potential buildup of systemic risk.
Systemic risk, that's the big one, the domino effect concern, right?
Exactly. The worry that if one major player fails, it could potentially pull down the whole system. SFTR data helps them see those interconnections, those webs of exposure between different firms.
Makes sense.
And it also helps them spot, potential loopholes or maybe emerging areas of financial instability that weren't visible before.
Okay, that paints a clear picture of the why. So let's get into the nuts and bolts. What are the actual reporting requirements? What kind of information needs to be sent off?
Well, a key point is that both parties involved in an SFT have to report the details. They send them to authorized trade repositories.
Both sides? Okay.
Yep. So if you're lending securities, both you, the lender, and the borrower have to file reports independently. And the level of detail needed is, well, it's pretty granular.
Like what specifically?
Things like the exact identities of both counterparties involved,
Yeah.
all the specific terms of the transaction, what type of collateral is being used, what's its value, how long is the transaction supposed to last.
Right, so the who, the what, the when, and the what's backing it up.
Exactly that.
Data.
But it goes further, too. They also need to report if any collateral they receive is then reused in other transactions.
Reuse. Okay.
And they need details on any margin calls during the life of the trade, plus, up-to-date valuations for both the securities and the collateral.
Wow, that's intense. And how quickly does this need to happen?
Very quickly. The deadline is strict. It has to be reported no later than the end of the business day after the transaction occurs. So that's T+1.
T+1, that's fast.
It is. And on top of that reporting speed, all these records, they have to be kept accessible for at least 5 years.
5 years. Okay, that's a serious amount of data flowing incredibly quickly then. So who exactly gets caught in this net? Who has to do all this reporting? It sounds like it must cover a pretty wide range of financial institutions.
Oh, it definitely does. The scope of SFTR is quite broad. It really sweeps in a whole host of market participants.
Snake?
Well, the obvious ones, banks, investment firms, but also central counterparties, CCPs, the ones that sit in the middle of trades.
Right, the risk managers.
Yeah. And central securities depositories, CSDs, where the securities are actually held. It also includes insurance companies, reinsurance companies, and even pension funds.
Pension funds too. Huh. So basically, pretty much all the major institutional players in the financial system are involved somehow.
Largely, yes, if they're engaging in these types of transactions. But here's a really significant point. The extraterritorial reach of SFTR.
Extraterritorial, meaning outside the EU.
Exactly. Even if a company is based entirely outside the European Union, say in the US or Asia, if they do securities financing deals with an EU-based firm, then they also fall under SFTR's reporting requirements for that transaction.
That is fascinating. So a U.S. hedge fund doing a repo with a French bank, for example, the U.S. fund has to report under EU rules.
That's basically how it works, yes.
Yeah.
It really underscores how interconnected global finance is, doesn't it? Oh. And how rules in one major region can ripple out worldwide.
It really does. Now, you mentioned something earlier that caught my attention. We've talked about transparency, managing systemic risk standard goals for financial regulation, really. But you said SFTR also helps fight financial crime. That feels a bit unexpected. How does that actually work?
Yeah, it might not be the primary goal, but it's turned out to be a really valuable side effect. Because SFTR gives regulators such a detailed, almost real-time view of this specific market.
Right, all that data we talked about.
Exactly. It makes it much easier for them to spot unusual patterns, things that might indicate something illicit is going on.
Like what kind of patterns?
Well, imagine someone moving large amounts of collateral around very quickly, maybe through lots of short-term trades, with no obvious economic reason. Or perhaps using complex chains of transactions to obscure ownership.
Whoa, I see. Layering, maybe?
Potentially, yes. Things that could be flags for market manipulation or attempts to launder money. The SFTR data makes those kinds of suspicious activities stand out much more clearly against the backdrop of normal trading.
So the sheer volume and granularity of the data act as a kind of high-tech audit trail, or maybe an early warning system for potentially illegal stuff.
That's a good way to put it, yeah.
Yeah.
The increased visibility into how collateral is moving, who owns what, when, it acts as a significant deterrent.
A deterrent? How so?
Well, if you're trying to hide dirty money or manipulate prices using complex SFTs, knowing that every detail is being reported to the regulator makes your activities a lot riskier, much harder to conceal.
Right.
There's an inherent accountability built into the reporting. It discourages using these markets for illicit purposes.
That's a really interesting, almost hidden benefit. But, I mean, I can only imagine getting all this data reported correctly and on time. It can't be easy. What are the big challenges firms face with SFTR compliance?
Oh, you're absolutely right. It's definitely not a walk in the park. Complying with SFTR is very resource intensive for firms.
Yeah, I bet.
They've had to pour significant investment into their technology, into their data management systems, just to be able to capture all the required fields, validate the data, format it correctly, and then transmit it accurately within that really tight T+1 window.
Sounds like a huge operational headache.
It certainly can be. I mean, we heard stories, especially early on, of teams working incredibly long hours just to get the reports out the door on time. And the stakes are high.
How so?
Because if you get it wrong, if there are inaccuracies in the reports, or if you fail to report on time, you can face some pretty hefty regulatory sanctions, fines, potentially. And it's not just about technology. It also requires really tight internal coordination. You need trading desks, operations teams, legal departments, compliance folks. They all have to be singing from the same hymn sheet to make sure everything is captured and reported correctly.
So it's a major technical and organizational challenge then.
Definitely both.
Now, look, we can't really discuss EU regulations these days without mentioning Brexit. How did the UK leaving the EU affect SFTR? Are UK firms still involved?
Right, good question. So, post-Brexit, UK firms aren't directly subject to EU SFTR anymore. Instead, they now fall under their own domestic UK version of SFTR.
Ah, a UK SFTR.
Yes, enforced by the UK's Financial Conduct Authority, the FCA. Now, currently, the UK rules mirror the EU framework very closely. They basically copied it over initially.
Okay, so it's similar for now.
For now, yes. But the key thing for firms that operate in both the UK and the EU, and there are many, is the potential for divergence down the road.
Divergence, meaning the rules could start to differ.
Exactly. The UK might decide to tweak its rules, or the EU might update its requirements, and they might not stay aligned. This could create a situation where firms have to navigate and comply with two slightly different sets of reporting rules for the same kind of business, depending on whether the counterparty is in the UK or the EU.
Wow, okay. That sounds like it could add yet another layer of complexity and cost for those cross-border businesses.
It certainly could. It's something they definitely need to keep a close eye on to make sure they stay compliant on both sides of the channel.
Right. Okay, so let's try and wrap this up. Pull the threads together. In this deep dive, we've really seen how SFTR is fundamentally about bringing transparency to these crucial but sometimes opaque securities financing markets in the EU.
Through that detailed reporting.
Exactly. Mandatory reporting by both sides, T+1 deadline. This visibility helps regulators monitor systemic risk, understand who's exposed to whom,
Yep, mapping those connections.
and we saw it affects a really wide range of players, banks, funds, CCPs, CSDs, insurers, pension funds. Crucially, it even pulls in non-EU firms when they trade with EU entities.
That extraterritorial piece, yeah.
And then there was that sort of surprising benefit how all this data actually aids in the fight against financial crime by making suspicious patterns easier to spot.
The significant side effect.
But it's not without its challenges. Compliance is tough, needs big investments in tech and data, strong internal coordination, and getting it wrong can mean sanctions.
Definitely resource intensive.
And finally, the post-Brexit world means UK firms have their own SFTR, which currently mirrors the EU's, but crucially could diverge over time, creating dual compliance needs for some.
That's a really good summary of the key points we've hit on.
So here's maybe a final thought for you, the listener, to mull over. Regulations like SFTR, okay, they're complex, they're demanding, no doubt about it, but they fundamentally change how we think about risk, about accountability in the whole global financial system.
It really shift the landscape.
So consider this. How might this demand for such incredibly detailed, granular data like under SFTR pave the way for even more advanced, maybe even algorithmic types of financial supervision in the future? And what are the potential trade-offs there, between that level of intense oversight and potentially stifling innovation or efficiency in the markets? It's definitely something worth thinking about as these regulations keep evolving.